It sounds crazy to say, but REITs are potentially becoming one of the most interesting asset classes out there right now, even from a forward-looking total return perspective. And one of the REITs that I own personally in my portfolio is VICI Properties, and they just released their latest quarter's earnings. Now, let's take a step back here for a moment. I just made a pretty interesting claim. REITs are one of the most interesting asset classes. Now, why would that be a controversial statement? Well, if you've been paying attention to the market, REITs have way underperformed over the last 3 or so years. We can see from 2020 through 2022, they pretty much kept up and even outperformed the S&P 500, but then we see a wide divergence in the performance between REITs and the S&P 500. Now, there's obviously multiple reasons for this, but the interest rate environment we've been operating in has definitely not been optimal for REITs over the last few years. Higher interest rates means less people are interested in REITs because most people are buying REITs because of those nice starting dividend yields. For example, VICI Properties, starting yield of about 5.23%. But that's not the only thing we have to understand about REITs right now. I'm actually putting out a report this Friday over on Dividendology.com pointing out why REITs are so interesting right now from a valuation perspective and discussing some REITs that potentially have massive opportunities. If you want to get that report, be sure to check out Dividendology.com at the link in the description. But here's one of the charts I've been studying lately. What we're looking is the annual returns for REITs over the decades. And historically speaking, REITs have actually done very well. A lot of people don't realize this because they've way underperformed the market in the last few years. But in the 1990s, REITs had annual returns of 13.5%. In the 2000s, 14.2%, and in the 2010s, 13.2%. That's market-beating returns during that time period. And then the 2020s hit, and so far the 2020s have not been the same as the previous 3 decades. Averaged over these 3 decades, the average annual return for REITs was about 12.4%, but from 2020 to 2024, REITs returned about 5.5% on average. Now, let me stop right there by making the claim there's a lot of bad REITs out there. And that's one of the reasons I'm actually not a huge fan of the Vanguard ETF VNQ. I much rather hand select higher quality REITs than just buy a REIT index. Because let me tell you what's been going on with a lot of REITs while they're operating in this high interest rate environment. The quality REITs are continuing to grow adjusted funds from operations while the share price went down, which creates very attractive valuations. And one of those REITs that's been happening to is VICI Properties. Now, to be fair, if we actually look at VICI's total return over the last 5 years, it's actually outperformed the S&P 500, and if we look at the last year, still slight outperformance versus the S&P 500, and year to date, VICI's done really well, up about 18.17%, while the S&P 500 up around 7.6%. But what's interesting is if we switch this to a 3-year return, VICI's way underperformed in the last 3 years. But again, I want to point out the valuation as a whole of the REIT market versus the S&P 500. What we're looking at here is sector PE valuations relative to history, and I know it looks like there's a lot going on, but here's what we need to pay close attention to. The S&P 500 current PE ratio is around 22, which if we look at the percentile rank over the last 10 years, that puts them in the 87% percentile, so it's valued at a much higher multiple than it has been historically speaking. Meanwhile, real estate is in its 29th percentile. So historically speaking, it's undervalued compared to how it's historically traded. And on top of this, REITs finally have a huge catalyst on the way for the first time in quite a while. The market is expecting a 90% chance that we will actually see rate cuts on September 17th, just a little bit over a month away. And while this is bullish news for the market in general, this is very bullish news for REITs. Again, why is this? Like I mentioned earlier, most investors are buying REITs because of the starting dividend yield. So the higher the interest rate is, the less attractive taking on risk in equities to get that yield is. So that's enough about the REIT market in general. Let's talk about VICI Properties specifically in this recent earnings report. Now, the first thing we want to look at is Q2 FFO of 60 cents per share was a miss by 5 cents, but revenue came in at about $1 billion, up 4.5% year over year, a beat by $8.1 million. But here's the biggest news. They actually increased their AFFO guidance for full year 2025. So even though there's a slight miss on FFO, they increased full year guidance for 2025. This is a really good sign. Now, if you aren't familiar with VICI in general, if we jump over to the dividend breakdown sheet from Ticker Data and plug in VICI, You can see all this data will load in thanks to the help of the ticker data add-on in Google Sheets. And like always, if you'd like to download any of these spreadsheets and get access to that ticker data add-on that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. But VICI has an attractive starting dividend yield, sitting at about 5.15%, maybe a little bit higher on a forward-looking basis, and they have a history of growing that dividend over time. Now, it's a relatively new REIT, but during this time period, they've been growing the dividend at a very high rate. 5-year dividend CAGR for a REIT at 6.63%. That's pretty impressive, and it's really impressive when you consider the high starting dividend yield of above 5%. Now, one of the concerns and really misconceptions that a lot of people have about REITs is when it comes to share dilution, and this is something we have to pay attention to. If we come down here and take a close look at shares outstanding, what we can see here when we look at most stocks would actually be very, very concerning. We're seeing massive share dilution. Now, why is this the case? Well, we fundamentally have to understand how REITs operate. REITs essentially have two ways that they can grow because by law they are required to pay out 90% of their earnings in the form of dividends. So therefore, in order to pursue acquisitions, to buy new properties, they have to either issue new shares to raise capital or they have to take on debt. Now, what we can see is during this time period here, share dilution was relatively minimal, but that's because they were operating in a low interest rate environment. It made a lot of sense to take on new debt, and we'll discuss their debt structure here in a little bit. But we can see in the last few years, it's mainly been share dilution. Why is this? It's because interest rates have been so much higher. So with that being said, this isn't necessarily a bad thing. It's pretty typical for REITs. It just depends on how well are they able to manage the capital they raised in order to generate returns. So really, what type of returns can they get from the capital they got from issuing new shares or either taking on debt? And what we're seeing is, again, they're now projecting about 4.4% AFFO per share growth for 2025. That's pretty solid growth for a REIT. And in fact, if we look at that from a Bogle's valuation perspective, we'll go ahead and jump into a quick valuation. Let's look at VICI Properties. Now, this is a REIT, so it's going to be quite a bit different from a typical Bogle valuation. But essentially what we would be looking at here is going to be AFFO growth instead of earnings growth. And then instead of shareholder yield, we would be paying attention to just the dividend yield, since shareholder yield also accounts for buybacks, but that doesn't really make sense in the case of REITs. But if they're getting about 4.4% AFFO growth, combined with a dividend yield at about 5%, combined with the fact they have the potential for multiple expansion as interest rates go lower, even if it's very little, maybe just 1.5%, all of a sudden you're looking at a very attractive total return when we sum these three together at about 11%. Now, we'll run it through actual REIT valuation models here in a minute, but this is a good way to start to visualize where are those returns coming from. You have the 5% yield, you have 4.4% adjusted funds from operation growth, and the potential for multiple expansion right now as interest rates go lower. It's important you understand where those returns are coming from. Now, let's talk about the actual business model for VICI here for just a moment. And this is something I love to harp on, and you've probably heard it before if you've heard me analyze VICI, but it's important if you aren't familiar with this REIT, what type of real estate they own, and why their lease structures make this REIT so attractive. Now, to start off, 100% of their tenants operate under a triple net lease. What does that mean? Well, a triple net lease or an NNN lease essentially means that the tenant is responsible for paying property taxes. It's responsible for insurance. It's responsible for all of the maintenance. So not only does this alleviate VICI from a lot of potential costs, but think about what that means. It means that the income they're producing from these properties is very predictable. It's very stable. There's not going to be a lot of fluctuations. They can model out what the future returns will look like quite easily without having to worry about an unexpected cost coming up every few years. This is why I love triple net lease REITs. Now, on top of this, the vast majority of VICI's portfolio is going to be based in Las Vegas. Now, depending on how you think about Las Vegas in general, that could be a good thing or it could be a bad thing. For example, we could see Caesars Entertainment makes up about 39% of their annualized cash rent. MGM Resorts, around 35%. The Venetian, around 10%. So just like that, you're talking about the vast majority of the rent they collect coming from Las Vegas. Now, historically speaking, Las Vegas has been a massive tourism hub. In fact, if we scroll down, this is something they highlight in their investors presentation. Las Vegas has grown a lot. They now have a hockey team, a pro football team. They recently held the 2024 Super Bowl and are going to be hosting the 2028 NCAA Final Four. Tourism over the last few years has been up, but there is some concerns about Las Vegas in general in 2025 because tourism has slowed down a little bit this year. But let me tell you why this isn't a direct concern for VICI as of right now. One of the worst years in history for real estate investment trusts was 2020. We saw REITs have massive declining share prices. We saw REITs cutting their dividend everywhere we looked. But this wasn't the case for VICI. Look at their 2020 rent collection. Even in the midst of the pandemic, VICI collected 100% of their rent. This is extremely impressive. This was not the case for the vast majority of REITs. But then on top of this, one of my favorite things about VICI is on this slide. Inflation is a major threat to any type of investment we make, but particularly when it comes to real estate investment trust, at least in some instances. But VICI accounts for this in the way that they structure their leases. We can see as of right now, 42% of their leases has rent roll with CPI-linked escalation. What does that mean? Well, basically for 42% of their properties, as inflation goes higher, the amount of rent they collect goes higher as well. But they're projecting that by the year 2035, this will be 90%. So I love VICI because it's really a sleep well at night REIT. I don't have to worry about inflation. If inflation goes higher, the amount of rent VICI collects goes up as well. So as a byproduct of that, when we were in an inflation rate environment during 2020, 21, 22, they continued to grow that dividend at a very high rate, a much higher rate than their peers. So now you should kind of understand why VICI, generally speaking, can be quite attractive to a lot of investors. But when it comes to REITs, a lot of investors will skip over what the debt composition looks like. And when you start talking about balance sheet metrics, particularly for REITs, this is where a lot of people turn away. They think it's too complicated, they think they might not understand, but I'm gonna break this down for you. It's actually very, very simple what we're looking at here. And again, you're gonna see why VICI is one of the more attractive and quality REITs on the market. To start off, they highlight 99% fixed rate debt outstanding. What does this mean? Almost all their debt has a fixed interest rate, which protects against rising rates, which again is one of the reasons VICI has been so successful even in a higher interest rate environment. And again, it makes future expenses more predictable. We can see 83% is unsecured debt. What does that mean? Well, basically, most of their debt is not tied to specific properties as collateral. So what's the benefit of this? VICI essentially has more financial flexibility. And then down here, we can see their debt maturity schedule. What is this telling us? Well, 6.7 weighted average years to maturity. Essentially, on average, they have around 6 to 7 years before their debt matures, which means in the short term, they don't really have any large refinancing risk. You can see this has been strategically staggered. And then to top everything off, we can see the credit ratings from the credit rating issuers down here, which remember, not in this recent earnings report, but in the one before that, VICI actually got a credit rating boost. So yes, like we already pointed out, in the last 3 years, VICI has underperformed the market. There's quietly been things going on with the underlying fundamentals that have continued to strengthen this REIT. Now, like I pointed out, they've already started to reap some of the benefits of this in the last year and year to date with large market outperformance. I loved adding shares of VICI to my portfolio when it was trading in that $28 to $29 range. And I certainly got lots of comments from people not understanding why I would do that when REITs are underperforming, but you have to understand every asset class is going to go through periods of underperformance. What you have to do is understand what's going on with the underlying fundamentals. Because if the underlying fundamentals are still growing, even while the REIT or the investment is struggling from a share price perspective, that means it's becoming a better investment opportunity. And that's exactly what's been happening with VICI. So is VICI still attractive at $33.54? Well, let's jump over to the ticker data REIT valuation model and come up here and plug in VICI. Thanks to ticker data, the model will load in, but the first one we'll look at is the AFFO multiples. And let me pause for just a moment and tell you, I'll be the first to admit this is not a perfect valuation model for VICI because there's really not any other REIT like VICI. But with that being said, we'll still use it to get a general idea of what a valuation might look like compared to peers. And here's two somewhat comparable peers based on how they're structured and size, and we can see the average P to AFFO multiple is about 14.87, while VICI is 14.05, which if we applied the same average to VICI, they'd be a fair value of about $35.54, a little bit higher than that current share price. Now, let's use the dividend discount model next. This is typically one of the better ways to value a REIT if you feel decent about the dividend growth future of the REIT. And from what we've just seen with the fact that VICI is going to be growing AFFO at about 4.4%, I think we can feel fairly decent. If we assume 3.75% dividend growth to VICI moving forward and an 8.5% discount rate, The dividend discount model gives us a fair value of about $37.79, which is about 12.68% upside from the current share price. On top of this, the AFFO payout ratio is about 74.48%, which is very solid for a REIT. Again, when it comes to REIT, we don't look at the earnings payout ratio, we don't look at the free cash flow payout ratio. That's another mistake a lot of investors make. We pay attention to the AFFO payout ratio, the true measure of the health of the dividend for a REIT. So when we jump over to the output tab, we'll zoom out just a little bit, we can see the two valuations we used. When we average them together, we come to an intrinsic value of about $36.65. So with a 10% margin of safety, your acceptable buy price would be about $32.98, which, to be fair, VICI is relatively close to that. It is a little bit above at its current prices, but based on the model, we found VICI is about 8.5% undervalued still, and they have the future catalyst of rate cuts on the way. Again, I'm going to be putting out another report on REITs that are attractive on dividendology.com here on Friday, so be sure to check that out at the link in the description. I'll send it to you for free. But we can see, even with VICI's outperformance in the last year, the REIT is still relatively attractive at current prices. Your job as an investor, again, is to decide what are your goals and to make sure you're looking at everything from the perspective of opportunity cost. So like always, if you'd like to download any of these spreadsheets and get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.